Hello everyone, I am Jacob Stein in Los Angeles. I'm an attorney with Alliant. We are a global law firm, and my practice focuses on international taxation, which is the topic of today's presentation. International taxation is a fairly broad subject area, right? International taxation covers transactions that our clients engage in when they go and do business outside the United States, right? When they operate in foreign countries, or make investments in foreign countries, maybe enter into joint ventures in foreign countries. International taxation applies when foreigners do business in the United States or make investments in the United States. International tax rules apply when we have foreigners immigrating to the United States. There are planning issues when you have Americans who expatriate, meaning they give up their U.S. citizenship or their permanent residence and leave the United States. And all of these are topics that deserve, from 1 to a few hours each. And obviously, today's presentation is only 1 hour, so we have to pick and choose what we are going to cover. So I thought that we will focus today's presentation on inbound taxation, meaning representing foreigners who are doing business or investing in the United States, or maybe moving to the United States, because for most of us, this is what we see most frequently. These are the international tax transactions that apply to most folks listening to this presentation. But I do want to spend a couple of minutes talking about the new Tax Act, the 2016 Tax Act, at least new to most of us. So the new Tax Act is the most significant overhaul of the U.S. tax system since 1986, and there has been some significant changes made by this Tax Act to the international tax rules, and mostly to the rules governing what's called outbound taxation. So outbound taxation refers to the U.S. taxation of transactions that start in the United States and then go outside the United States, right? So Americans doing business overseas. So a few of the changes that this Tax Act has introduced. One is the United States, with respect to some taxpayers, has moved to what's known as a quasi-territorial tax system. What does that mean? Well, we used to be a purely global tax system, meaning that the United States would tax anyone subject to its taxation on worldwide income, right? So if you are a U.S. person, if you are a U.S. legal entity, it does not matter where you generate earnings around the world, the United States will tax you on those earnings. Many countries have a territorial-based tax system. They will tax you only on income earned within that country and not on income earned in other countries. So the United States made kind of a small move from worldwide taxation towards a territorial tax system. And under the new tax rules, if you have a corporate taxpayer, if your client here in the United States is a corporation, and your client owns a 10% or greater interest in a foreign corporation, then your client will not be taxed on any dividends it receives from that foreign corporation, at least to the extent those dividends are attributable to the foreign earnings of that foreign corporation, as opposed to U.S. earnings. So this is almost kind of a territorial tax system. So let me give you an example. Let's say that our client is going to be selling waffles in Belgium, a very profitable business, they tell me, right? So if our client, let's say it is a U.S. corporation, is going to go to Belgium directly and sell waffles, right? It's just a U.S. corporation engaging in business in Belgium, and it's making a profit. What are the U.S. tax consequences? Well, our client will be taxed by the United States on its income in Belgium, right? So worldwide taxation right now still applies. Under the old rules and under the new 2016 Act, if you're directly operating a business overseas, you're taxed on the income from that business, subject to the controlled foreign corporation, the Subpart F regime, which we're not going to get into right now. So I just want to illustrate the changes. Let's say that instead of operating the business in Belgium directly, Our U.S. client is going to set up a Belgian corporation and is going to own that Belgian corporation, right? It's going to have a foreign subsidiary. And this foreign subsidiary in Belgium is now going to make waffles, make a profit. What are the U.S. tax consequences? Well, in the old days, meaning last year and before, whatever earnings the foreign corporation generated were not taxed by the United States because these are earnings of a foreign entity. But when that foreign entity paid a dividend to the U.S. parent, the U.S. parent was subject to a tax, right? An ordinary tax on the dividends it received from its foreign subsidiary. So here the new act introduces a change. Now when our U.S. parent gets a dividend from its foreign subsidiary, the U.S. parent is not taxed on that dividend. It receives a 100% dividend received deduction. So effectively it's not taxed on dividends received from a foreign subsidiary. So it means now that U.S. businesses are able to operate overseas through subsidiary companies, right, through subsidiary corporations, repatriate earnings to the United States by receiving a dividend and not be taxed on that dividend, right? So effectively, the United States is not taxing these U.S. corporations on their foreign-sourced income. So it's almost like a territorial tax system, right? Foreign-sourced income is not taxed. It's interesting that this new tax act only creates this favorable regime for corporate taxpayers. So if you're an individual that owns a foreign corporation, you don't get the same break. You will still be taxed on the dividend you receive from your foreign corporation. If you are a U.S. pass-through entity, right, like a partnership of some sort, you're still taxed on that dividend. It's only corporate taxpayers that do not get taxed on their foreign-sourced dividends. So I think that's very interesting. The other big change of the new tax act is there's a one-time tax on income that is overseas that has not been previously repatriated to the United States. And this is a provision that targets companies like Apple and Google and the like. So Apple, for example, has something like $250 billion overseas in its Irish subsidiary. This $250 billion that's been accumulated since the early 1980s has never been taxed by the United States. And the United States is saying that we're going to tax it. We're going to impose a one-time tax on those unrepatriated earnings. And once we tax it, you might as well bring it back. And that's exactly what a lot of these big companies are doing, or at least they're saying they will be doing, is they have to pay the tax. They don't have a choice. And then they might as well bring the money back. So a lot of capital will now flow as a result of this back into the United States. And this one-time tax is about 15% on cash assets that you have overseas, and I believe it's 8% on all other types of assets. Again, applies to corporate taxpayers. There's a new minimum tax on global intangible income, which I'm not going to get into. So it's kind of an interesting new world. I'm not quite certain why such distinctions has been introduced between corporate taxpayers and non-corporate taxpayers. Perhaps it's politics. I'm not sure. Corporations getting breaks, but it is what it is. So this changes some of the outbound tax planning that we engage in. Traditionally, when we structure overseas operations of our U.S. clients, we would focus on two things. One, can we structure the foreign entity we are setting up, the foreign business we are setting up, so it would not be classified as a controlled foreign corporation, right? And that has to do with the ownership rules. Who are the shareholders of this foreign corporation? And in this regard, there also have been some changes under the new Tax Act. So the new Tax Act changed the attribution rules of who are related taxpayers for controlled foreign corporation purposes, making it easier to attribute ownership and have a foreign corporation classified as a controlled foreign corporation. It used to be that to test for whether a foreign corporation is a controlled foreign corporation, the rules would look at whether U.S. shareholders have sufficient vote, like do we meet the 10% vote requirement. Under the new Tax Act, it's 10% vote or 10% value, which is sufficient to have someone be treated as the so-called U.S. shareholder of a foreign corporation. So for outbound, is it a controlled foreign corporation? So there are slight changes. And I think they've broadened the rules, right? More foreign corporations will not be classified as CFCs. And the other thing that the rules look at is what is the income that the foreign corporation is generating? Is it generating subpart F income? And these rules have largely remained intact. They really have not been changed by the new Tax Act. But now we do have these advantages to U.S. corporations that own foreign corporations with these dividend received deductions. There is now also for foreign earned intangible income, there is I think a 37.5% deduction. So it creates incentives for U.S. businesses to maybe engage in more exports and do things overseas. We don't have these deductions and these tax benefits for individual taxpayers, so pass-through taxpayers. So whereas before, under the sort of the traditional choice of entity analysis, we would often shy away from using corporations, except for the largest of clients. Now, at least in the outbound arena, we may be using corporations to be able to take advantage of these favorable tax rules. Okay, so that's really all I wanted to say about outbound taxation. We can now come back to inbound. And inbound looks at how the United States taxes U.S. activities of foreign investors. So if you have a client who has assets in the United States, any sort of investments, owns and operates a business in the United States, enters into a joint venture in the United States, these are the rules we will discuss now. And there are two types of taxes that we're mostly concerned about with respect to our foreign clients. The first one is a transfer tax, right? And the transfer tax is kind of a broad term, and it includes both the estate tax and the gift tax. What are the estate and gift taxes that apply to foreign corporations, foreign individuals, who are somehow in the United States? And what can we do to give our clients a good result? So before we get into the rules of how these transfer taxes apply to foreigners, we need to understand first who is a foreigner, meaning who is a foreigner for U.S. tax purposes. So this is a concept that's technically known as a distinction between a U.S. taxpayer and a non-resident alien. So who is a non-resident alien? Because if you're a non-resident alien, you are a foreigner, right? And once you are a U.S. taxpayer, right, you are no longer a non-resident alien, you're a U.S. taxpayer, the same exact tax rules will apply to this person as would apply to any other U.S. taxpayer. So it's a very important distinction to understand, because foreigners are taxed differently, very differently than U.S. taxpayers. So a non-resident alien for transfer tax purposes, so again, this is for the purpose of the gift tax and the estate tax. A non-resident alien is someone who does not intend to make the United States their permanent home. Maybe they live here. Maybe they actually have a big, beautiful home here. Maybe their family lives here. Maybe they've been living in the United States for many years. But in the long run, they do not intend to make the United States their permanent home. They intend to return one day to whichever country they came from. And this is something that actually happens quite often. For example, we have foreigners who move to the United States to work. It may be on some sort of like a short-term, 1, 2, 3-year visa, work or extraordinary talent type visa. They may move to the United States to be with family, but there is this intention to one day to return to the country they came from. Technically, you can even have this intention if you have a U.S. green card. That gets a little bit hairy because a foreigner who gets a green card basically has to make a declaration that they intend to permanently reside in the United States. But I guess they can tell the IRS one thing and the INS something different. So an argument can be made that someone who does not want to permanently reside in the United States is a non-resident alien. And many foreign clients that we represent do fall into this category of a non-resident alien. Maybe they don't live in the United States at all. They're just investing in the United States, right? They're buying real estate here. We see lots of foreigners buy real estate all across the United States. They are running a business here. They come and visit here, right? But this is not their home. So how do we tax them? So first of all, if you have a non-resident alien and this non-resident alien has assets in the United States, on their death, their U.S. assets are subject to the U.S. estate tax. The U.S. estate tax applies at a rate of 40%, right? So 40% of fair market value. And this 40% tax applies almost up of the first dollar. For a foreign taxpayer, only the first $60,000 of assets will be excluded from the U.S. estate tax. Compare that with how the U.S. estate tax applies to U.S. taxpayers, right? U.S. taxpayers also get hit with the same 40% tax, but it only applies once your net worth exceeds $11 million. So here, $60,000. But remember, this is not $60,000 of net worth. This is $60,000 of the assets in the United States, because the United States does not have jurisdiction to tax assets that are outside the United States. The $60,000 exemption was intended to cover personal belongings that a foreigner may have on them, with them, when they're traveling in the United States, right? So if you're a foreign tourist, you're traveling in the United States. If you happen to die while in the United States, whatever miscellaneous possessions you may have with you as a tourist, right, should not be subject to U.S. tax. But once you start acquiring more significant assets, you buy a real property, you buy a business, what have you, there will be a 40% estate tax on that. And this is huge. This is huge because this applies to almost every single foreign investor, because most of them invest more than $60,000 in the United States. And this is also huge because this is something that most foreign clients just do not plan for, because no one tells them to plan for it, right? For example, we represent a lot of Asian clients, Chinese, Taiwanese, Vietnamese, what have you, who come to the United States and buy real estate, right? And how do they buy real estate? Well, they hire a real estate broker in the United States, and that's their only point of contact in the United States. Perhaps there are some family members here. But no one is giving them proper advice. No one is telling them that, hey, you buy this real estate and then you're going to go back to Taiwan. On death, 40% of the value of your U.S. real estate will go to the United States government. So what do we do to get around this fairly draconian tax that applies to foreigners? Well, so first of all, there are certain types of assets that this tax does not apply to. And these are the types of assets we want to direct our foreign clients into. The most important one from a planning standpoint is that the United States can only impose the estate tax on U.S. assets, right? So if a foreign client has non-U.S. assets, the tax does not apply. So what do we do with someone who wants to buy something in the United States? Is it possible to take U.S. real estate, an interest in the U.S. Business, and make it a foreign asset? And turns out that it is possible. Turns out that instead of owning assets in the United States directly, perhaps we can own assets in the United States through a foreign corporation, or even better, through a foreign trust. Right? So imagine that Taiwanese client who wants to buy U.S. real estate. If he buys it in his name, on that 40% estate tax. But if he forms first a corporation, I don't know, in Samoa, and the Samoan corporation buys U.S. real estate, then when that individual client dies, well, has nothing to do with the United States, right? Because we have a Samoan corporation own the real estate. That will continue. Doesn't change on the death of the shareholder, right? So the U.S. estate tax does not apply. So almost always for foreign clients, we want them to own U.S. assets through a U.S. corporation. That avoids the U.S. estate tax. I believe that an even better structure is to own U.S. assets through a foreign irrevocable trust, because not only does that avoid the estate tax, it also allows us to engage in much more creative tax planning. It allows us to leave assets to the kids, right, and avoid probate. And there are certain other advantages of using trusts that are beyond the scope of this presentation. But this is a structure we use very frequently, and sometimes we will have a foreign trust own a foreign corporation, which will then in turn own U.S. assets, either directly or maybe through a U.S. disregarded entity. What do we do if we have a foreign client with U.S. real estate and they already own that real estate, or they already own some sort of another asset in the United States? What can we do with that existing asset? Because the United States does impose a gift tax off of the first dollar on the value of gifts of U.S. assets that a foreign investor makes. So if you have a foreign client who owns U.S. assets and they gift those U.S. assets to anyone, a 40% gift tax applies off of the first dollar of value. So I represented a client just recently, a Chinese client, bought a $2 million apartment in San Francisco. Must have been a very tiny apartment. And after he bought it, he was told that, there's this estate tax, and it may not be a great idea for him to own U.S. real estate in his name directly. But he already bought it. What can we do with it? Because now if he gifts that apartment to a foreign corporation, to a foreign trust, to his kids directly, the 40% gift tax will apply off of the first dollar, right? And $800,000 goes to the United States Treasury. So fortunately, there is a very nice planning loophole for making gifts of U.S. assets. So an asset that is not subject to the gift tax is an interest in a legal entity, like an interest in a limited liability company. Why? Because an interest in a legal entity is an intangible asset. And intangible assets are sourced to the jurisdiction of where the owner is located. So if you have a Delaware LLC that is owned by a Taiwanese national who lives in Taiwan, the interest in the Delaware LLC is deemed to be a Taiwanese asset and non-U.S. asset because it's an intangible asset. It is sourced to the jurisdiction of ownership. So if we have a foreign client gift a U.S. limited liability company, the gift tax does not apply, because for gift tax purposes, the client is deemed to be gifting a foreign asset. So one of the frequently used structures for foreign investors is to take the assets that they already have acquired in the United States, transfer the ownership of these assets to United States limited liability company. That can almost always be done on a tax-free basis. And once the real estate is in this LLC, the LLC gets gifted into whatever structure to whichever person we need to gift it to. There are some planning caveats you need to be aware of here. So for example, if it is real estate that is going to go into this LLC, which will in turn get gifted, we have to make sure that the transfers are not subject to FDAP. We'll get into FDAP in 1 second. In some states, you may have to deal with real estate transfer taxes. In a state like California, you have to deal with property tax reassessment issues. But all of those are addressable and can be fixed. Okay? So for foreign clients with U.S. assets, whether it's real estate or an interest in businesses or U.S. intellectual property or artwork or whatever else, please make sure that those clients own their U.S. assets either through a foreign corporation or through a foreign irrevocable trust. And if they already happen to own the assets, there is a strategy of how to get those assets into these offshore corporations, trusts, and so forth without paying gift taxes today. Let's talk about receiving gifts. A question that we get very often from our clients is the following. I have family money overseas, and my family would like to transfer money to me in the United States. Is that legal? Can they do that? What are the tax consequences? And as you can imagine, with larger families, with wealthier families, this is a question that comes up often. So family members want to transfer money to you. How do we do that? Well, it turns out that this is a very simple thing to do. All they need to do is wire you the money. Just wire you the money. And you have to make sure that what they're gifting to you, these foreign relatives, will be a foreign asset. For example, if your foreign relative comes to the United States, sets up a bank account in the United States, puts $1 million into that bank account, and then says, here you go, here is $1 million, that may be subject to the gift tax, because that is a U.S. asset that is now being gifted. So the gift has to take place outside the United States. And I believe that a wire that originates outside the United States and then lands here is a gift of a foreign asset. So have your relatives gift assets to you. Although I do know that some practitioners, to be as safe as possible when doing this planning, will have their U.S. clients set up an offshore bank account, have the foreign relative wire the money into the client's offshore account, and then the client brings the money back into the United States. And that is a very safe approach. There's nothing wrong with that other than the hassle and the headache of having to set up that overseas bank account and then close it after the transfer. But that's a valid approach. I don't think we need to go through that trouble in most cases. So receiving a gift of foreign assets is never taxable, right? Because the gift tax is always imposed on the person making the gift. And if it's a gift made by a foreigner of a foreign asset, the United States has no jurisdiction, neither over the person making the gift nor over the asset being gifted. But the person receiving the gift, the U.S. person, the U.S. taxpayer receiving the gift, although they are not taxed, they have to report the gift if the gift exceeds $100,000. And it's sort of an aggregate test. So if in the aggregate, during the tax year, you have received over $100,000 of gifts from overseas, you have to report these gifts. And there is a form 3520, on which you report the foreign gifts that you have received. This is purely an information filing. There is no tax on receiving the gifts. It's perfectly okay. If in some cases clients are very worried that the gift may be attacked by the Internal Revenue Service and reclassified as something other than a gift. I wonder why they have these fears in some cases. So they're worried that maybe the IRS will argue, well, this is not really a gift. This was your money all along. This is earnings you have from some foreign sources, and you're trying to make it look like it as a gift. That is a very difficult argument for the U.S. government to make. Not impossible, but it is a difficult argument to make because they don't really have access to any evidence to prove their argument. And to a large extent, they will have the burden of proof here. But we do want the client to be able to support their argument that they are receiving a gift from a family member. And really the only thing they can do in a case like this is to get from their family member maybe some sort of a gift declaration, which will state the fact that I am making a gift to a family member. It's an act of detached and disinterested generosity, which is a tax term, and therefore, because it is a gift, it will not be taxable. So it's nice to have something simple like that in writing. Okay, let's move on. So again, to summarize, U.S. transfer taxes are something that a lot of foreign clients do not plan for, but applies to most of them as soon as they have assets in the United States. Okay, so now that we've talked about the transfer tax, let's talk about the income tax, and this is a biggie, the income tax. So first, before we get into the various somewhat technical rules that apply to foreigners doing business in the United States, let's briefly pause and talk about, again, this definition of a foreigner. Who is a foreigner for U.S. Income tax purposes versus who is a U.S. resident? So a foreigner here has a slightly different definition. Or by foreigner, I mean technically non-resident alien. So what's the distinction? Well, a non-resident alien will be someone who does not have U.S. citizenship, right? Because if you are a U.S. citizen, you're automatically a U.S. taxpayer, tax on your worldwide income. A non-resident alien is someone who also is not a permanent resident of the United States, right? Because as soon as you are a permanent resident of the United States, like you have a green card, you are immediately a U.S. taxpayer, subject to tax on worldwide income. And so you can be a non-resident alien only if you're not a citizen, not a permanent resident, and you do not spend too much time in the United States. So what do I mean by you don't spend too much time in the United States? There is the so-called substantial presence test. And the substantial presence test looks at the number of days a foreigner is present in the United States. So, for example, if a foreigner is present in the United States for 183 days during a calendar year, they are a U.S. taxpayer. They don't have a permanent visa. They are not a citizen. They have no intention of staying in the United States for a long time. But if you've spent 183 days or more in the United States during a calendar year, in that calendar year, you are a U.S. taxpayer. And this is a test that is done on an annual basis, right? Every single calendar year, our foreign clients must calculate how many days they have spent in the United States. And there is a formula test that looks at how many days they have spent in the United States over the past 3 years. There is a test of how many days they spent in the United States this year to determine whether they're a resident or non-resident alien. Remember that for transfer tax purposes, right, we looked at intention to permanently reside in the United States. That is a very subjective test. The substantial presence test is not a subjective test. It's a purely objective test. We just count the days. And so many of our foreign clients who spend a fair amount of time in the United States will keep a little journal where they will tally nonstop. They will always tally how many days they are present in the United States. Right? I arrived on such a day, I left on such a day, I was present for 24 days. And then they add it up. And when they get to a point where they get close to some sort of a cutoff that we have determined for them, and this cutoff can be based on the number of days present this year, but it's also maybe done sort of cumulatively, meaning how many days were they present last year or 2 years ago. And there's a special weighted average formula that adds up those days to determine if you're being pushed into being a U.S. resident. And please keep in mind, why is it so scary for our foreign clients to get classified as U.S. taxpayers? U.S. taxpayers are taxed on their worldwide income. So as soon as these foreign clients exceed the number of days they're present in the United States, they are now immediately taxed on worldwide income by the United States. And that becomes a very scary and very expensive proposition. So very, very important for our foreigners to keep track of their presence in the United States. If someone is present in the United States for over, let's say, 183 days in a year, what happens? Then they're deemed a U.S. taxpayer, right? Worldwide taxation, as I mentioned. But also it means they're just subject to exactly the same tax rules that everyone else in the United States is subject to. So it's not an interesting topic of conversation. What is interesting for us are those foreigners who manage to remain classified as non-resident aliens, meaning they didn't get a permanent residence visa, and they're not spending too much time in the United States. They're foreigners, right? The foreigner sort of in the colloquial sense of that word. Or for tax purposes, they are non-resident aliens. Well, can the United States tax a foreigner? And the answer is yes, if there is jurisdiction to do so, meaning something must be happening in the United States. We cannot tax a foreigner on their foreign income, but we can certainly tax a foreigner on their U.S. income. That we can do. So first, let's talk about taxation of real estate, because for most of our foreign clients, this is their primary asset. This is what they gravitate to almost immediately, right? This is sort of a safe place for foreigners to keep their wealth. Real estate is something they understand, right? It's tangible. They can feel it. They can see it, and it's safe, right? So a lot of foreign investors come from clients where the economic climate or the political climate is not as safe as the United States. Things are always sort of topsy-turvy. Tomorrow there can be, a revolution or a confiscation of assets, or new currency controls can get imposed. So a lot of foreigners look to the United States as a safe haven for their wealth. And then we have a transparent judiciary system. We have a fairly low level of corruption compared to most other countries. There are no currency controls. So it's very easy for foreigners to get into the United States, keep their wealth here in a form they can understand, like real estate, and then get out when they're ready to do so. So how does the United States tax a foreign investment in real estate? Well, the primary set of rules that you should be aware of is FDAP. FDAP stands for Foreign Investment in Real Property Tax Act. I believe FDAP was introduced in 1980, and it was introduced in response to massive, mass-scale Japanese investment in U.S. real estate. And FDAP provides that when a foreigner sells U.S. real estate, we will withhold 15%, used to be 10, but now it's 15% of the sale price. That's not the tax. We're just withholding 15% of the sale price. Why are we withholding 15% of the sale price? Well, so first of all, what does withholding mean for those of you who are not tax lawyers? Withholding means that whoever buys real estate from a foreigner in the United States can only give that foreigner 85% of the sale price. And the remaining 15% of the sale price, the buyer, must send to the United States Treasury, right? So it's an obligation that is imposed on the buyer. So the sum of money, this 15%, goes to the United States Treasury. Why do we do this? Well, we do this because if you're dealing with a foreigner, once that foreigner sells the real estate, they will take their cash and they're going to go back to, Angola, and we will never ever collect an income tax from that person again. Right? And there is an income tax. Foreigners are subject to the same capital gains on the sale of real estate that everyone else is subject to. But, those of us who live in the United States, the United States Treasury has an easy way of collecting from us. They can find us. They can find our U.S. assets and collect from those assets. If you're a foreigner, especially some country with which the United States does not have a great relationship, there's just no easy or maybe no possible way to collect. So what we do is we provide that we must collect now. And we're not going to collect from the foreigner. We're going to collect from whoever is going to give money to the foreigner. And if that buyer of real estate, whoever is buying from a foreigner, does not withhold 15% and remit it to the United States Treasury, it becomes their obligation. That 15% is the obligation of the buyer, and if they fail to withhold, they are liable for that sum plus penalties and interest. Right? So there's a very strong incentive for buyers of real estate to make sure of who are they buying from. Right? So that's why whenever you buy real estate, part of the sale process, they will make you sign a certificate of non-foreign status. And, and the seller will sign this certificate, And if they are not a foreigner, they will say, I certify that I am a U.S. taxpayer. And then you do not need to withhold. You are allowed to rely on that certificate that the seller provides. But if they're a foreigner, you have to withhold 15%. But that's not the tax. 15% is not the tax. It's just the sum of money we withhold and effectively keep a surety. The foreigner next year will file a U.S. income tax return, calculate their U.S. income tax obligation, right? We sold real estate, we have certain basis in it, we have a gain, and then the 15% withheld will be applied as a credit against that tax liability. And if too much was withheld, the difference will be refunded to the foreigner. And if not enough was withheld, then perhaps the foreigner pays more, or too bad, the United States did not get enough money, which may happen. So that's FDAP. Particularly, it is important whenever you're representing buyers, because the obligation to withhold may be imposed on your client. And what else you need to do is understand that this obligation to withhold applies not just to direct sales of real estate. It may also apply to sale of an interest in a legal entity that owns U.S. real estate, right? So if you have an entity that primarily owns real estate in the United States and you're selling an interest in that entity, the interest in that entity will be treated as U.S. Real estate. So again, be careful of the transactions your clients engage in. Moving on to next, the kind of broad category of income that foreigners are subject to. And this is probably the broadest category of income for foreigners, the one that applies most of the time. And this is fixed determinable annual or periodical income. Fixed or determinable annual or periodical income. So this is sums of money that gets paid on some fixed or periodic basis. How does that work? So let's say you are, again, a foreigner and you buy shares of Apple and you get paid a dividend. Similar concerns exist as under FDAP. Once the foreigner collects that dividend, it will be difficult to chase them down for their tax obligation. So for lots of sort of passive types of income, mostly passive types of income like interest, dividends, rents, royalties, salaries, commissions, things like that, the United States imposes a flat tax on the foreigner. Right? It's a flat tax of 30%, and this tax must be collected at the time of payment of the income, meaning that when Apple pays a $100 dividend to a foreign shareholder, Apple is mandated by the law to withhold 30% of that payment, remit it to the United States Treasury, and that is the tax obligation of the foreign shareholder of Apple, and they're done. No tax returns to file, no money to get back. That's your tax. It's been withheld. It has been paid. You're done. Okay? So this is what's called the withholding tax. Flat tax, 30%. So if Apple pays a $100 dividend, they cannot actually give the entire $100 to the foreign shareholder. They can only give the foreign shareholder $70, and the other $30 they have to send to the United States Treasury. And once that tax has been paid, again, the foreigner's tax obligation to the United States government has been satisfied, and the foreigner himself is not under any obligation to do any tax filings or reportings in the United States. Okay, so look for mostly passive types of income. There are exceptions to FDAP income. The huge exception are capital gains. When a foreigner has non-real estate capital gains, right? So capital gains that are not connected to the sale of real estate, then that foreigner is not subject to U.S. tax. Okay, so foreigners are not taxed on capital gains from the sale of U.S. real estate. Non-U.S. real estate assets. So if a foreigner buys the same shares of Apple and then sells them at a profit, no U.S. income tax applies, right? Because that's a capital gain. It's gain from the sale of a capital asset. If a foreigner buys intellectual property in the United States, resells it at a profit, the income tax does not apply. Okay, so any asset that is not real estate, foreigners are not subject to capital gains. This was intended and designed, and I think successfully so, to attract foreign investment in the United States, right? Because foreigners now know they can buy U.S. assets, they can sell U.S. assets, other than real estate again, and they will not be subject to any sort of income tax, right? So it attracts a lot of capital into the United States, makes the United States a more competitive environment for foreign direct investment. There are certain other exceptions. A couple, the big ones are bank deposits. So if a foreigner places money in a U.S. bank, interest income paid, and I realize it's not a lot nowadays, but whatever interest income is paid on a bank deposit is not subject to U.S. taxation if the bank account is owned by a foreigner. And the other big exception is portfolio interest, interest from a portfolio interest loan. So portfolio interest loan is a loan where the repayments by the terms of the loan must be made outside the United States, right? So they must be made to a foreigner outside the United States. If we have a loan with specific language like this, then the interest payments that are going to the foreign lender are not subject to the 30% withholding tax. They're just not. And this, the portfolio interest exception becomes an important planning tool, because often we will try to structure infusions of cash into the United States as portfolio interest loans to get away from the 30% withholding tax. Okay, how else can we get away from the 30% withholding tax? Well, if the foreigner who is getting the income from the United States lives in a country with which the United States has an income tax treaty, the 30% tax will always be reduced to a lower number. And it will be reduced to anywhere from between 0 to 15%, right? So for all the tax treaties, the highest tax rate on interest, on royalties, and dividends, what have you, will be 15%. The lowest will be 0, right? So with our strongest trading partners like Canada, UK, Germany, countries like that, we usually will have the lowest withholding taxes. And then with other countries maybe with whom we do not have such strong relationship, but there is a tax treaty, it will be reduced to 15%. So that's the foreigner's tax obligation in the United States. Again, it does make the United States a more attractive place for foreigners to invest, reducing this overall tax burden. The United States has about 60, I want to say off the top of my head, double income tax treaties. So, you know, some number of countries, but not all. And certainly we do have income tax treaties with almost all of Europe and with other big developed countries like Japan, Australia, and so forth. Okay, moving on. The next category of income is known as effectively connected income. So effectively connected income is income in the United States that a foreigner has that is connected to U.S. trade or business. And if you have income that is connected to a U.S. trade or business, that income is subject to the exact same income tax rules that apply to any other U.S. taxpayer, right? So that makes it somewhat simple. Maybe not very attractive to our foreign client, but very simple, right? Why is it not attractive to our foreign client? Well, because if you are subject to the same tax rules as anyone else, it means you have to file tax returns in the United States. You may have to report your U.S. and non-U.S. income. You may have to engage in certain apportionments of income. So foreigners often want to avoid having effectively connected income. We'll talk about that in a second. And the other kind of big downside of effectively connected income is the so-called force of attraction rule. And under the force of attraction rule, if a foreigner does have a U.S. trade or business, almost all income they generate in the United States will be deemed attracted or connected to that U.S. traded business and now taxable by the United States. There are obviously exceptions to this, but under the force of attraction rule, foreigners are subject to sort of standard U.S. taxation of their business and other operations in the United States. Where this gets really sort of hairy, I guess, is when we have foreign clients who do not really operate a business in the United States, but they use independent agents to conduct certain activities in the United States, like maybe to engage in certain negotiations, to raise money, to sell products on a commission basis, to enter into contractual relationships, and all these different activities that agents can engage in. Depending on what the agent is doing for the foreign principal, the agent may be deemed a dependent agent of the foreign principal, and if that is the case, then all the activities of the agent in the United States will be attributed to the foreign parent. And now this foreign parent may be deemed doing business in the United States, and effectively connected income rules will apply. So you have to be very, very careful when you have a foreign client who is maybe not doing anything directly in the United States, but they do have some sort of contractual relationships with U.S. agents that do things on their behalf, and we need to very carefully examine those contractual relationships to see whether attribution comes into place. Let me talk a little bit. We don't have slides in this presentation on the subject, but let me speak in the time remaining on pre-immigration tax planning, which nowadays is becoming really kind of a huge topic, something that in our practice we see very frequently. So pre-immigration tax planning deals with representing interests of foreign investors or foreign clients who are about looking to move to the United States, right? So this may be someone who is looking to move to the United States and get a green card. This is someone who may be looking to move to the United States just like on an L1 or even O1 visa. It doesn't really matter, maybe even an EB5. The idea is that these people are moving, like physically, right, moving to the United States, legally moving to the United States on some sort of a visa, and they will spend some amount of time in the United States, which will get them classified as U.S. taxpayers, right, because they're spending too much time here. Or maybe they're getting a permanent residence visa, like a green card or EB5, although I understand that EB5 is a conditional permanent residence visa. But they become U.S. taxpayers, right? And once they become U.S. taxpayers, they're taxed on their worldwide income, and all of the assets they own around the world are subject to the 40% estate tax. I'll give you a recent client example. We're representing a French family that is moving this year to the United States. The parents and the little kids are moving to the United States. This family has a net worth of about $400 or $500 million. Most of their businesses, most of their income sources, most of their assets are outside the United States. So today they have like virtually no U.S. taxation. I think they're just running like a small business in the United States, which is taxed. No U.S. taxation, and the way they have it set up, they're really not paying income taxes to any country, which we do not have to get into later, but I guess it's one of the advantages of the tax systems of other countries. There will be no inheritance tax on death when the parents pass away and leave this, let's say, $500 million to their kids. Once they become U.S. taxpayers, and they do intend to move here permanently, certainly all of their worldwide income, which is fairly significant, becomes subject to the U.S. income tax, and also the entire $500 million on the death of the parents will be subject to the 40% U.S. estate tax, which is, again, a very significant number. What can we do for these folks? So let's start off with the estate tax. To avoid the estate tax, we need to get the assets out of our clients' names. What can we do? Well, prior to immigration, there are quite a few things that can be done. Something that is instinctual for most folks is to say, hey, let's move assets into the name of our children, which technically would work, right? Because if the parents move assets into the name of their little kids, then when the parents die, they will not own these assets. The kids will. The estate tax will not apply, right? Which is nice. It's a good result. But is it smart? Is it a good idea to really have little kids own assets? Regardless of how little or old they are, they're kids, right? Meaning that, first of all, they now control the asset. They now control the assets, which means that they can do anything they want to with them, which may not be a smart thing. And second, what if something happens to the kids? They have a lawsuit against them, some sort of creditor issues, and they own the assets. So what we aim to do is we aim to maybe transfer assets into a trust for the benefit of the kids, especially drafted types of trusts, so that the assets will not be included in the U.S. estate of the parents. Right? And before they move to the United States, there are no transfer tax issues, at least no U.S. transfer tax issues. So we can take this entire $500 million estate, move it into various trust structures, and by the time these people hit the United States, there is no U.S. estate. Everything is in trusts. So that's number one. Number two, for income tax planning purposes, are there things we can do to sort of help them with their income tax result? Well, there are certain things we need to focus on. One is that these folks have assets that they likely have owned for a long time, and they may have either zero or very low income tax basis in these assets. So like this family has a home in France worth about $30 million. It's been in the family for generations, so the basis in that home is probably fairly low. And if they sold that home after moving to the United States, most of that $30 million will be subject to the capital gain tax. But there are transactions we can engage in which will increase the income tax basis of that home to $30 million. And today, before they move to the United States, we can do that without any tax consequences. Right? So they moved to the United States, and we want to make sure that all of the assets they own around the world will have income tax basis equal to fair market value. So should the assets get sold the next day, there is no income tax. And that's a great result. We can set up structures so that the money that is being generated overseas, their offshore businesses, will continue to not be taxed by the United States. At least there is a deferral there. Maybe it's not taxed indefinitely, but our client controls when they will be taxed, which is a great result. And then there's quite a bit of other planning that goes into it. That concludes this 1-hour presentation. I always make myself available to answer questions from folks who have taken or listened to my presentations. You're always welcome to reach out to me. My email address is jstein, Jason Jacob, jstein at alliantlaw.com, ALIANT law.com, alliantlaw.com. I hope you've enjoyed this presentation and learned something new. I am Jacob Stein, and thank you.